Hey everyone. Today, we're diving into an explainer on a platform that has completely shaken up how we look at data, forecasting, and current events. We are, of course, talking about Polymarket. Now, if you followed the 2024 US election, you definitely saw these prediction markets popping up literally everywhere. But our goal today is to go way beyond those catchy headlines. We're going to unpack the underlying crypto technology, dig deep into the actual statistical accuracy of the data, and even trace the surprisingly long legal history of betting on democracy. So you gotta ask yourself, is Polymarket a genuine crystal ball, or are we just looking at a digital casino? You know, when you first open the interface, it's super easy to assume it's just a digital roulette wheel for political junkies. But as we'll see from the data, treating it like a standard gambling site completely misses the incredibly powerful and, yeah, sometimes pretty risky financial mechanics working under the hood. Okay, let's dive into this. Here's our roadmap for the explainer. First, we'll look at trading opinions versus casino bets. Then the crypto and oracle mechanics. After that, prediction markets versus traditional polling. Then we'll explore the wisdom of crowds. And finally, we'll wrap up with legal history and market risks. All right, kicking things off with Section 1, trading opinions, not casino bets. Think about traditional betting for a second. You place a wager against the house, and your money is totally locked up until the game is over, right? You win or you lose. Simple. But on a prediction market like Polymarket, you're actually trading against other users. The prices are constantly moving, exactly like a stock market, reacting in real time to new information and public sentiment. So let's say you buy a yes share at 10 cents, and then some massive breaking news pushes public opinion up to 50 cents. You can just sell and lock in your profit right then and there. The event doesn't even need to be over. You are literally trading opinions. Now, to really understand the current landscape, we have to look at the two major players out there. Polymarket is crypto native, it's historically been global, and it built its whole brand on charging zero trading fees. You're only paying the spread between the buy and sell prices. On the flip side, we have Kalshi. They are a US regulated platform using traditional US dollars, but they do charge explicit trading fees. Interestingly, following some regulatory settlements, Polymarket is actually rolling out a CFTC regulated version for US users, which puts these two models in direct competition. And for savvy traders, this split landscape creates some really cool potential arbitrage strategies. Like, imagine buying a yes share cheaply on Kalshi and simultaneously selling it higher on Polymarket to lock in a completely risk-free spread. Moving right along to Section 2, the crypto and oracle mechanics. Since Polymarket is built directly on blockchain technology, it operates as a non-custodial platform. That means your funds aren't just sitting in some corporate bank account controlled by Polymarket. You hold them yourself in a crypto wallet using a digital dollar called USDC. But with great power comes great responsibility, right? This requires some serious personal security. A highly recommended strategy here is the two pockets approach. You keep your active trading funds in a hot wallet, like MetaMask, and then you sweep your profits into a disconnected hardware wallet for secure storage. This not only protects you from hackers, but honestly, it protects you from your own emotional all-in impulses. Which brings up a great question. How does a decentralized platform actually know who won an election or what happened in the real world? Well, they use an oracle system. Polymarket doesn't manually sit there and decide what's true. Instead, when an event ends, any user can stake real money to propose the outcome. Then a challenge window opens up. If the proposed outcome is wrong, other users are financially rewarded for disputing it. It's an absolutely brilliant decentralized system where the truth is determined simply by creating a financial incentive to correct lies. That brings us to Section 3, prediction markets versus traditional polling, specifically looking back at 2024. So the crucial point we need to make here is a psychological one. Traditional polls will call people up and ask, who do you intend to vote for? That measures desire. But prediction markets ask, who do you expect to win? Because actual, real money is on the line, bettors tend to put their personal desires aside and bet on the most likely reality. It's a subtle distinction, sure, but according to researchers analyzing the 2024 data, it's a deeply revealing one. And this isn't just theory. When researchers at Vanderbilt University crunched the data, they found very distinct statistical signatures. Prediction markets operate like what's called a random walk. They are highly dynamic, churning out daily closing prices that react instantly to breaking news. Polling data, on the other hand, behaves a lot more like Gaussian noise. Because polls have to rely on intermittent sampling over several days, they remain much more static and clustered together. They really struggle to capture sudden shifts in public momentum. Let's move to and see how this builds when we look at the timeline of the summer of 2024. You can see this dynamic playing out in real time. During massive historic events, like the assassination attempt on Donald Trump in July or Kamala Harris becoming the Democratic nominee just over a week later, the Polymarket odds reacted almost instantaneously to the shifting landscape. Meanwhile, the traditional polling averages basically stayed flat, hovering right near a 50-50 split. By the time we hit mid-October, the prediction markets had clearly diverged from the polls, taking a much more definitive stance on the expected outcome. All right, Section 4, the wisdom of crowds. Have you ever heard of the wisdom of crowds? It's this really well-documented statistical theory that posits that the average judgment of a massive, diverse group of people is actually often more accurate than the predictions of a small group of experts. You see, traditional polling requires really complex statistical weighting to correct for demographics, which unfortunately can unintentionally introduce bias. A market simply absorbs all available information, insider knowledge, local news, public sentiment, and organically distills all of it into a single unified price point. Just look at how this played out in the 2024 swing states. The market's predicted power was pretty stark. Polymarket confidently predicted Arizona, Georgia, North Carolina, Pennsylvania, and Nevada weeks ahead of the actual election. Interestingly, for Michigan and Wisconsin, the market oscillated right around 50-50, which perfectly reflected how incredibly tight those specific races were in reality. In contrast, the polling models for almost all of these states basically hovered around chance levels with wide margins of error for the entire cycle. Now, what's really interesting about this slide is the risk it highlights. See that $30 million figure? That represents the very real risk of market manipulation by whales. During the 2024 cycle, a single entity placed roughly $30 million in bets across multiple accounts. This introduces the massive risk of wash trading, which is where a single user artificially inflates the trading volume to make a specific outcome look way more inevitable than it actually is. It's a stark reminder that, yes, these markets can be manipulated. Which leads us perfectly into our final part, Section 5, Legal History and Market Risks. Did you know that betting on political outcomes actually has a centuries-long history? It's true, going all the way back to the Victorian Election Proceedings Regulation Act of 1856. Common law has seriously wrestled with this concept. Historically, wagers involving electors were often completely voided by courts because lawmakers feared a bet could simply be a disguised bribe. Think about it. If I bet you $1,000 that your candidate loses, I might just be buying your vote. Fast forward to today, and prediction markets carry some new, hidden, systemic risks. For example, if you bet on a super niche, illiquid market, there might not be a buyer waiting when you want to cash out, completely trapping your funds. Plus, let's be real, you are often trading against people with massive information advantages. If a political insider already knows a candidate is dropping out, they will happily sell you a yes share. You aren't participating in a poll, you're just their exit liquidity. And on a deeper level, legal scholars are increasingly warning about the commodification of democracy, turning our fundamental civic duty into just another financial asset to be traded. So I want to leave you with this final, somewhat provocative thought. The data clearly shows that prediction markets react faster and, in many cases, more accurately than traditional polling. But does gamifying democracy with money really create a clearer crystal ball? Or does it invite manipulation that slowly erodes the integrity of the very elections it's trying to predict? It's a totally fascinating balance between brilliant data responsiveness and profound ethical risk. Thank you so much for joining me for this explainer. Keep learning, keep questioning, and I'll catch you next time.